All right, Matt, how are you, man? Our next episode of going live with Good Soil. We were at a conference last week and got to meet each other personally for the first time, and I think 10 or 11 months of working together. It was pretty cool conference. Except I came back with a little COVID, unfortunately, so I'm a little out of it. Hope everyone excuses me if I'm a little slow today. Sorry about that.
Yeah, it was great to finally meet you in person, and yeah, it was kind of hilarious. I think we mentioned this at the beginning of last week, although we had some technical difficulties. But you thought I was like, I don't know, 6 inches shorter than I actually am, or something like that. So that was kind of funny. That was like your
You're
very
much
first
taller.
reaction.
Yeah, I was like, man, you're
Yeah,
taller. You're so tall. I was surprised. So it was my first react. Yeah, I admit, that was funny. Yeah,
it's a funny time though, and we can essentially be working together on a business for almost a full year without having actually physically met each other. But it's good to kind of get that milestone out of the way, and we had a lot of good times, and kind of interesting going to a conference like that. It almost feels a little bit outdated
hmm
in this day and age to have a physical conference. And in fact, I mean, we gave a presentation about Tesla while we were there, which had, I don't know, like 10 people, and it was like a really good conversation, kind of back
yeah,
and forth with some of the audience. But then, we do like an impromptu live stream about Tesla earnings, and you get, I don't know, 500 people showing up. So there's
yeah,
definitely some benefit to having just complete, like, widespread distribution through the internet to people who are interested in the topic, rather than just kind of whoever can make it to a conference. So I think it kind of
absolutely.
reinforced our commitment to be kind of more open on the social media platforms, and prioritize that as opposed to like kind of the traditional way of managing a hedge fund.
Yeah, absolutely. Yeah, I think it was good for us to see and know that's probably not the forum for us. That type of traditional in-person conference. So it was good to know that, and I'm glad we did it. We got to meet each other, and it was fun getaway. Anyway, we got to meet another colleague, Eric from Worm Capital, who interviewed us recently. That was fun, and even got a night of poker in with him. That was cool. So anyway, let's move on to the topics of what people are here to listen to us talk about. the
Yeah,
the macro
absolutely.
market first. We usually start off with talk a little bit about the market volatility, macro market, any news headlines, and then we move into like Tesla and other stocks and take Q&A. That's sort of the outline of this for the next 45 minutes or an hour. So for the market volatility, what's your thoughts, man? I mean, it's been up and down. We had a big up day yesterday, last day of January. Today, February. It's we're at least we're not bouncing back down, which is good. It wasn't like a doesn't seem like it was a dead cat bounce yesterday. It seems like
Yeah,
people are
yeah. I
coming
kept
back to the market.
like every week in January, it seemed like, oh my gosh, it's like another, down 10% day, or down 10% a week every week, it seemed. So that was that trend just seemed to kind of be uninterrupted. There was just a lot of fear, obviously, around macro factors, particularly inflation, and kind of Fed balance sheet shrinking, and what the repercussions of what that would do to capital markets. So it seems like we've maybe reached a point of at least temporary stability. But I think the thing that markets are taking into effect now, if you look at like the yield curves, the difference between short-term and long-term yield curves, is kind of pricing in. It looks like about five different 25 basis points increases that to the Fed funds rate this year. So that's kind of where we are right now, and that's I think more than people were expecting maybe a month ago. So I think that's why your growth stocks in particular have been pounded so much. Um, and it does make a pretty big difference. I mean, just as a maybe to give it like a sensitivity analysis to people who are maybe not as familiar with the topic. I did a valuation like a year ago for Tesla, where I came up with like a $2,900 price target. But that's highly dependent on the different interest rates that
hmm
you use, because that's a kind of an input into the cost of capital assumption. So if you actually kind of increase the rate to oh geez, now I've lost my sheet here. I had it up a second ago. But the high level number though is like, if you go from about 1.5% discount rate, which is what it was a year ago on like the 10-year Treasury, and if you add 1% to that, then it takes off about like $600 off your share price, and if you add 2%, then it takes off about $900. And so then if you go crazy and say you add like 5% to it, then it more than cuts the share price in half. just because the cash flows, when you're doing a discounted cash flow valuation, are so heavily weighted to the future. So obviously that's only with one model. I mean, depending on your inputs and your assumptions, the answer will be different. But I think that's what you're seeing here is like, oh gosh, if people thought it was kind of inconceivable that the rate might be 3.5% or 4% in a couple of years' time, but I think the market is giving an increased probability weighting to that potential outcome as kind of a means of fighting inflation. So it's kind of very interesting to see the sentiment shift so quickly. But what are your kind of thoughts on this dynamic environment we have going on right now?
Yeah, I mean, I do agree that with generally everything you said there, and I think the 5 rate hikes for this year being priced in is sort of priced in now. I think there's a lot of people still scared that thinking that the actual action of the rate hike is going to cause the market to go down, but I don't think that's the case anymore. I think the anticipation of the rate hikes going, 5 rate hikes this year is what made the market go down. That anticipation has already happened now. So I think maybe when the rate hikes actually happen, then the market might actually start going up, sort of like, sell on the rumor, buy on the news kind of thing, So, it just seems that unless there's signaling for even more aggressive hikes this year, I got to think that we've hit some kind of local low in the macro market. That's what I'm thinking is more probable. I could certainly be wrong. There could be a Russia-Ukraine invasion that causes all kinds of uncertainty and energy prices and spirals to the whole macro market somehow. So there's other things that could happen. But when I'm just thinking about the interest rate environment and speculation around that, I feel like the worst of it is now priced in. So we'll just see how the next month especially plays out, because I think we need a solid, a week or a couple weeks of sort of like at least a flat market to kind of feel more comfortable about that. Because for several weeks here, there'd be like maybe one flat day, then the market's down 5%, then another flat day or up 1%, down 5%, or at least the growth in tech stocks. At least that's what we focus on. So it's almost like its own index, the growth in tech stocks. I feel like the ARKK, you could think of it as almost.
It is kind of crazy. I mean, like if you look at both to take two names that we talk a lot about here, both Roblox and Rocket Lab, they went from all-time highs to all-time lows in a matter of like 2 months. It was like a remarkable turnaround, and so that's clearly not based on like fundamentals, and that's clearly not based on like an increase in the discount rate from an expected 2% to an expected 3% or 3.25%. Like that doesn't drive that kind of movement. So there's clearly an amount of kind of panic, and where is the bottom? I think you're right. If we do kind of consolidate around here for a week or 2 or 3, then I think it will be a bullish sign for that capital that we've talked about that's kind of sitting on the sidelines to maybe reemerge and be deployed into some of these names. But I think people are a little bit, nobody wants to be the first to call the bottom and start deploying your capital. We saw a little bit of that with like Bill Ackman kind of calling the low on Netflix, and we saw that kind of rebounded nicely. So there may be some more kind of one-off names like that hopefully kind of turn the tide. But it's
and earnings this week is going to be a big. Yeah, I mean, Google, I think, is today earnings. Facebook is this week, and there's a lot of big names giving earnings this week, and all the smaller growth tech companies will probably give earnings the next few weeks after. So, as long as earnings are strong, which I anticipate they should be, like Microsoft, Apple, and Tesla were, then I think there's, I'm feeling comfortable. There's definitely skittishness in the market, but medium to long term, I feel comfortable.
Yeah, I mean, this is something we were talking a little bit about offline too, but it's like, the confidence in at least the portfolio that we manage from here is like, it's a lot easier to kind of like the upside potential from here versus maybe where we were in November. Yes. As like painful as maybe the short term, I'm sure everyone's feeling this in their personal accounts as well. Everything's been hit, even if you're in more safe sectors than maybe we are here at Good Soil. I think everyone's seeing red across their personal portfolios, but the growth stocks I think have been hit incredibly hard. But I do think one of the things that's going to happen is like there was a lot of froth in like kind of crappy SPACs and like companies that didn't really have a lot
Yeah,
of
a lot of story
business being
stocks. Yeah,
like, $2 to $5 billion stocks. And like, people just don't know much about them, but they're like, oh, this company has space in their name, or like, oh, this
yeah,
company says the metaverse is going to be awesome. And so it's like,
yeah,
right,
yeah,
they've got to be at least worth $1 billion. So
yeah, yeah.
there was a lot of that kind of nonsense going on. And so I think in a way, this kind of downturn will be healthy because it kind of sets the bar lower for everyone. And so then you'll be able to more clearly differentiate between, okay, who's actually innovating, who actually has great technology, and who is just kind of great at doing a deal and throwing buzzwords around and raising capital, because those companies will not be successful even in the medium term, I think.
I agree. Yeah, there's lots of good sales pitches out there with the SPACs that are, easy to buy into, and definitely there's a lot of hype, and very few of them will come true, in my opinion. So we're seeing a lot of those SPACs kind of die. A lot of the EV, SPACs even. Yeah, I mean, that's just an example. So yeah, we'll see what happens in the long term with those. But yeah, SPACs beware. Most of them are very, even though Rocket Lab was a SPAC, right? But some SPACs, we think there's legitimacy to, but the vast majority, you have to really be careful. So yeah, so I mean, I'm moving on to Tesla. We haven't had a real call since we haven't had a chat since the fourth quarter earnings release. We had a brief, on the spot fly chat, right after the earnings release before the call, but then there was the earnings call with Elon Musk and the product roadmap update being that there's no real update. Like, we're just sticking with these models. We're sticking with the Model 3 and the Model Y, and we're just sort of pump as many of those out we can this year. But basically, that was sort of the update I interpreted, because just demand is crazy. So what were your thoughts on the earnings call and the results now that you've had some time to digest, Matt? What do you think?
Yeah, I mean, so we had kind of revised our earnings model going into it, with some more bullish assumptions based on the increase in deliveries that we got from the production and delivery report. So I think we were expecting something resembling a blowout, and this quarter clearly was not that. You had kind of shrinking automotive gross margins, which was kind of a surprise. And when I went back and did kind of like a post-mortem on the financials and kind of compared them against my model, I modeled in, or when I updated the results in my financial model, I'm coming up with like a declining FSD take rate, at least in Q4, but also kind of lower automotive gross margins on top of that. So to me, that's kind of a surprise that you'd have, with so many more vehicles being produced in Q4 than in Q3, and with the price hikes, which had been layered in over the second half of 2021. To see kind of declining gross margins, even like the core manufacturing margin, which is what I call it when you back out full self-driving credits and everything, that was a little bit surprising to me. And so I think that was there's reason to have kind of tempered expectations going forward into 2022 for that reason, which Zach Kirkhorn clearly said on the call as well. So that was probably the biggest surprise to me is not only was there not margin improvement, but it was actually a little bit worse than had been than they posted in Q3. But I also think what Elon and Zach are saying on the call is completely true, which is that as like the current financials don't really matter that much in the context of full self-driving.
Mm-hmm.
And this was kind of my original core thesis, back in 2019 when I kind of went all in on Tesla, was like, if you have a increase in take rate from, I think it was 29% back then when they had disclosed it. And so I was doing some modeling and say like, okay, if you take that up to 40%, just because it's like the coolest new feature that everyone's going to want to have, it just like explodes the financials of the company in the like kind of crazy ways. And I think that dynamic, it's actually over the past 2 years, it's gone the opposite way. Take rate's actually gone down. But in my mind, that's kind of good news, because the core manufacturing is way more efficient than anyone thought was possible. And we still have all this kind of upside improvement possibility when full self-driving does improve to the point where people are like, oh my gosh, this is the new must-have feature. So like we were talking about this a little bit, I think, on our call last week, but if you take the operating cash flow, which is just like the cash flow that the business generates before like investments in CapEx into new factories, and you divide that by the number of vehicles that they delivered, it was something like $15,000 per vehicle, which is a crazy number. But if you, that's basically equivalent, it's slightly higher, but it's basically equivalent to like the full self-driving price. So you can imagine a scenario where, let's say, take rate goes from 10, 15%, somewhere like that right now, to close to 100%, then you'd essentially be doubling the profitability per vehicle. So the improvement potential there is crazy. And I think it's something that nobody is really taking into consideration, at least on Wall Street, in terms of what does the 2022 financials look like. So that's a real catalyst, and especially if they keep increasing the price over time, and people start to give the robotaxi autonomy bull case credit, and then there's all this upside on top of that. So I think no matter how you look at it, 2022 is shaping up to be a beat, even with plugging in some more kind of conservative automotive gross margin numbers in my model. So that was encouraging to me, I think.
Yeah, Wall Street just has no idea how to value the full self-driving. I mean, they have their models of how they value auto companies, and Tesla's an auto company with, that to most of them, most of the dinosaurs on Wall Street, the institutional firms, the big shops that have a lot of money they manage, and whether it's Fidelity on the buy side or sell side research, or I just feel like there's a huge advantage for retail investors or individual investors like us, that, can make up their own mind without having analysts use kind of traditional modeling techniques of, auto manufacturers and such. So, I think this is just an enigma. Tesla's an enigma. No one knows how to value it, and it's just kind of like, it's kind of crazy. It's just sitting out there for us in the open for all of us to kind of pick up shares at this current valuation, when we all know full self-driving is pretty imminent at this point. And like you said, like Elon said, it's nutty or something. He said it's just the financials are nutty. and I believe him. I mean, there's no reason not to believe Elon. There's some people that just, it's crazy. Like when I see people that are bearish on Tesla or Elon, it comes down to two things, right? Either number one, either they think Elon is intentionally a liar, intentionally deceiving people, or number two, they think they're smarter than Elon. And I don't think that's the case for anyone I've seen that's, even a smart person that's, sort of bearish on Tesla or Elon. Like, it's just funny how I can't think of another reason why people would be bearish or not believe what he's saying. But I believe him. The financials are about to get really nutty, and 2022 is likely, but worst case 2023, full self-driving is basically here. And the beta users, you have the beta version, you see how fast it progress. You told me yourself, that it's progressing super fast and surprising you. And that's just in the last couple of months. And you were kind of skeptical when you first got it even, and you've seen big improvements. So yeah, I mean, what's your personal use case on full self-driving? That's it. That's the real, canary in the coal mine for Tesla's financials is, people using the full self-driving beta, are they really seeing progress or not?
Yeah. So it's kind of crazy how quickly it has improved. So, I mean, I only got it in October, and it was, I've been pretty public about how bad it was, honestly. It would just kind of block intersections in a strange way, and it was super kind of erratic around stops and that sort of thing. And I think it was in this last probably 10.9 where I just all of a sudden became really surprised. I was like, oh, it's like seeing things that I didn't think it could see, and it was like handling turns much more naturally. I still intervene a lot, so I don't want to kind of give the impression that it's like, oh, it's basically like ready for autonomy tomorrow. And there's still a lot of stuff that it has to handle. Like frankly, on like there's a lot of snow where I am right now, and it does not handle that very well. So there's still a long way to go for sure. But it's like the things that were making it so annoying to use like a month ago are like completely gone now for the most part. So it's like kind of astonishing to see that just the huge pain points are gone now. And so it's like now the pain points, I'm getting acclimated to the new pain points, and I'm like, oh, it's like turning out of a parking lot. It's not very good because it doesn't know. It needs to get in like the left lane versus the right lane. So it kind of goes in the middle and blocks people. So I'm like, all right, I'll take over that. But then once it actually turns, handles it perfectly. And so, the goalposts I think are always moving on what does it need to do to get to the point where it's like actually level 4, like Elon says. but I honestly think like we've hit something of a local maximum. I had a tweet about this earlier today, but like they've been working on this full stack rewrite for it's got to be close to a year now, I think, right?
Yeah, like a long time. Yeah.
A very long time. So like all
It's
these
basically going to be
improvements-
vision. It's going to be vision only for highway and local city driving, right? It's going to combine it all to be vision
it's
only. Is that the local?
it's
Is that the stack rewrite? I think.
yeah, it's that, but I think it's also kind of introducing the time element to it for the first time. So my understanding, anyways, and maybe we should get James Dauma on here to kind of
Yeah.
clarify the areas where we're wrong. But it's looking at all the frames individually right now, and the software is kind of making driving decisions based on that. Whereas in the rewrite, which is V11 is supposed to come out this month, which will have that full stack rewrite according to Elon. You're going to be threading together all the different camera streams and introducing like a time aspect to it, where you're kind of tracking these objects over time more so than they're doing right now. And so my understanding is that should be kind of like the backbone that all of the future kind of iterations work off of. So once that kind of rolls out and we can see how it goes and we can see how quickly the improvements happen on that version of it, I think we'll have a much better idea whether or not we can really trust Elon on this kind of level 4 by the end of this year comment, which he seems so strong on. But so I'm very, very curious to see that once it finally rolls out.
Yeah, I mean, I think we'll have a period of time where it's going to be very comfortable, like sitting in the highway, the car drives itself, and I have to sit there. I can't get out and go to another seat, obviously, but it drives itself, the whole time on a highway, and I'm comfortable with it. So I think we'll have a significant period of time where it's like that everywhere, and hopefully that's what he means. I think that's what he means, and with full self-driving, ready, capable, and maybe it could be a while before there's some laws passed or there's some enablement in certain cities and Miami, let's say, or some place in Arizona where they say, okay, now Tesla can drive everywhere without a driver in the car. So we'll see how long that takes and then how long that catches on. But I think people will like I can imagine all the DoorDash drivers, all the Uber Eats, Uber drivers, all those people will definitely want it, like for their job, like they can do other things and just let the car drive itself to do everything for them, so you'll have a huge implementation of people that drive for a living, I think, first, and then you and I, people like us, will all start buying it too, and it's just a matter of time then as it gets better and better quickly after that too, with more data, and it's going to take off. Yeah,
and I think there's maybe this false dichotomy some people have, not you, but some people out there, that's like, oh well, if robo-taxis don't happen, it doesn't really matter. And I think that's not at all true. Like, even if it's just the best possible convenience feature, and people love it, that's still a huge kind of financial impact to the company. So just for example, I'm grabbing my Q4 numbers for this year. My base case assumption, which has a 19% full self-driving take rate, has earnings per share of $4.93. But if I assume that that's 100%, which sounds aggressive, but let's just say Tesla prioritizes FSD orders over others, and they've got like a 6 to 12 month backlog. That, to me, that's a very possible outcome. But it goes from $4.95 in earnings in that one quarter to $7.85. So like huge financial implications to the company, and you don't need to like be solving autonomy completely, or you don't need a robo-taxi fleet and regulatory approval to do that. All you would really need is just for the functionality to be good enough that you can have 500,000 to 600,000 orders where full self-driving is attached, and then you just prioritize those, and all of a sudden people see, oh gosh, like that's so cool that your car can drive that, and then they tell their friends, and then that friend orders it. So I think there's a real possibility that just the full self-driving as a convenience feature can itself kind of really have a crazy financial impact to Tesla.
Yeah, absolutely. Yeah, it's exciting. So why don't we go to is there anything else you want to talk about or unpack with Tesla fourth quarter results or the call or anything, or should we just go to Q&A? Any other thoughts about it, Matt?
No, maybe I'll just say there was one kind of mystery item in there, which was a little confusing to me, which was the long-term deferred revenue balance spiked by about $900 million.
I saw
this
your tweet
quarter.
on that. Did you get any good answers on that or anything
No,
insightful?
people had a
So
lot of
explain
theories
this.
out
Yeah.
there. So yeah, it's going to get like really nerding into accounting details. So I'll maybe try to keep it at a high level. But essentially, Tesla has this deferred revenue balance, which a lot of it is full self-driving. So you pay for full self-driving. Let's just say $10,000 for example. Tesla could only book about 5,000 of that, 5 to 6,000 as revenue because they hadn't delivered all of the features to the end users. So per GAAP accounting rules, they got the 10,000 of cash, so that goes onto their balance sheet as a cash item. They can book, let's say, 6,000 as revenue, so that goes into the equity side of the balance sheet. But then they have this liability for the balance, which is $4,000 in that case. So it's a liability classified as deferred revenue, and so whenever they deliver that feature set, it wipes out of the liability side and goes to the equity side. It's kind of the journal entry of how that works. But in this one quarter, you saw a huge spike. It went from, I think it was like 2 billion to 2.9 billion. So a huge spike, and it was all on what's called the long-term portion of deferred revenue. So it's revenue that they don't expect to recognize in the next 12 months. So it's kind of a mystery to me who or what group of customers would be paying $900 million of cash for something that's not going to be delivered for 12 months or more. So people had a lot of ideas, but to me, there's not a clear kind of answer that would satisfy all the different things. Like it can't be an increase in just full self-driving take rate because the current portion of that would have flowed through gross margin. Sorry, I got construction going on here. It's a little.
That's okay.
The banging's a little bit loud.
It's okay.
So yeah, it seems like the best possible answer I think I've heard so far, and even then I don't really like it, but is like maybe there's some amount of deposits for either semis or large battery pack orders. Well, Roadsters, to me, that one doesn't make sense to me because you'd have to have a huge influx of orders just in Q4 and like $900 million worth to increase the balance that amount. Q4 over Q3 doesn't really make much sense. So, okay. It could. To me, it seems like it'd have to be something long term, like a huge semi order or
a huge fleet order of some sort.
A huge fleet order, or it could be something on the energy side. But even then, it's like who would pay $900 million?
So it could be some big order they took in that's sort of under wraps. They haven't disclosed, but it's showing up on their statements. The cash they took in.
It could be, yeah. It could be that, but then it's hard to say like who's going to pay that much. Like normally payment terms are like, I don't know, 1 to 5% up front, and then like there's like a milestones along the way. So like if you imagine it was a huge stationary storage deal, for example, why would somebody pay $900 million up front, which is like.
I see some people in the chat.
Entire energy sales. Some
people in the chat saying Hertz, but I think they already promised to deliver all the cars to Hertz by the end of 2022, and they're already delivering them. And my understanding is Hertz is just paying it as they get them, just like any other customer, as far as I know. Yeah,
that's true. So like the Hertz deal that wouldn't make sense because it would be both current and it wouldn't go into deferred revenue. So I think some sort of long-term deal might make sense. I mean, the other potential thing would be like maybe there's like some sort of prepayment for like access to superchargers from another auto OEM or something like that. But again, that to me, that doesn't make sense that it would be long-term and rather than short-term. So just throw that out there. If anyone has any ideas, let me know. Let us know in the comments. But I haven't seen any good theories right now that kind of explain what would cause that huge amount of cash to come into the company without with something that's not going to be delivered for 12 plus months.
Yeah, that's interesting. Mystery. Well, we'll get to the bottom of it and report back when we figure it out one of these days. Yeah, that's a good one. So, yeah, with that, let's just go to the Q&A and get to as many questions and answers as we can in the next 20 or 30 minutes. Yeah. All right. These are people that are putting their questions on the Twitter thread or the YouTube live stream that Alec is posting. So from TG, is it true that the new Model 3 coming out of Austin will be 2,100 pounds less than the current configuration? I don't know if that's true or not. Have you heard anything about that, Matt?
No, I haven't heard anything about that. To me, that sounds unlikely. I mean, that's a huge that would be a huge mass removal. So I don't know how they could possibly do that.
Yeah.
So I hadn't heard that rumor, but to me that sounds unlikely.
Yeah, and I think Austin's going to do just really exclusively Model Ys initially. I'm not sure the Model 3s will be coming out of there anytime soon, but maybe. Yeah. From Alan Court, finance videos question: Where do you the average year over year revenue growth for Roblox for 2032? Average of 40% plus year over year. I haven't projected. I don't think we know what the heck's going on in 2032 for any company. He's hardly even Tesla. So that's pretty far out in the future. 2030, 10 years from now, the world is going to be very different. We try to maybe think about 5 years out, and with Tesla, we try to go a little further out theoretically with the bot and all that stuff. But for virtually every other company, it's hard to really go more than 5 or 6 or 7 year, think that far ahead, especially even with Rocket Lab. So we'll just have to go to the next question here. Let's see. From Life at 130 beats per minute on Twitter, is your MicroStrategy option trade still profitable after the recent Bitcoin crash, or did it break down at some point?
Yeah, so we actually stopped doing that trade. I don't know, what was it, like October, November? Yeah, it's probably after October.
Before the crash, yeah.
Yeah, before the crash. So thankfully we didn't kind of hold the bag on those shares at like an $800 cost basis or something like that. It might be a good time to start that back up, though, again, honestly.
Yeah, but theoretically, the trade, the way it was with selling the options weekly and the implied volatility, theoretically, we instead of losing, if we held the shares and the stock, MicroStrategy dropped by 50%, instead of us losing 50% on that because we're selling options around it, we might have lost like 20 or 25% instead of 50% in such a short period of time. That's theoretically the idea of it. We could, I guess, back test to see what actually would have happened if we kept doing it, but we did. Luckily, we sort of stopped it in October, November. Yeah. What were you gonna say, Matt?
No, just exactly that. So yeah,
okay.
we
might be a good time to consider it again. Yeah.
Yeah.
All right. From Dan Mac 51 on Twitter, SARK versus ARK in 2022. Yeah, I mean, 2021 was the year of SARK. 2022, I think, is the year maybe ARK comes back. I don't know. That's my guess. What do you think, Matt?
Yeah, and maybe for those who are not familiar, there's this short ARK. I don't know if it's an ETF or a fund or whatever.
It is an ETF. Yeah,
it's an ETF. Okay, yeah. So essentially, like, some people are, it's like, they're smarter than Elon Musk syndrome. So there's also smarter than Cathie Wood syndrome.
Yeah.
So people are like, I don't want to think for myself. I just want to think that Cathie Wood is an idiot. So I'll do the opposite of whatever she does, and it'll probably make money. So like, I agree. I think ARKK is gonna. I think there's potential for ARKK to do really, really well this year, but it's going to be driven by macro. I think, like, if macro deteriorates, or like if there's a huge kind of GDP crash or something like that, which I don't think is likely, but there's at least a thoughtful or a thoughtful cohort of kind of economists or commentators out there who think that, like, the sky is falling. And so if that happens, sure, SARK SARK will do really well. But I'd put my money on Cathie. I think she's got a lot of great insights into macro. And the more I've been hearing her kind of speak, the more I've tended to think, okay, I don't agree with everything that she says, but I think her points seem to have a little bit more validity than kind of the doomsday economists out there.
Yep. From Scott Opened Your Eyes on Twitter, what metrics ratios do you find most important to value a company at a maturity stage, such as Rocket Labs? Matt, you want to take a first stab at that one?
Yeah. So just from a pure valuation standpoint, it's like, they're burning cash. Their revenue is small relative to their enterprise value or their market cap. And so, like, if you're looking backwards only in the financials, there's not going to be a lot to like. So, as much as like of a technical kind of like financial analyst, and I love digging into companies' financials, it's really not the best use of time for a company like Rocket Lab, to be honest with you. With a company like Rocket Lab, I think you have to kind of take off your financial analyst hat to some degree. You can't be an idiot about it, but you got to take that off a little bit and look at the market that they're in, and look at their technology, look at their leadership, and kind of look at it almost more like a VC than like a normal Wall Street analyst. So like when it does come time to do evaluation, which we've done here, like a revenue multiple is probably the best that you can do, because trying to assume what gross margins are going to be in 2027, and like that's a losing game. You're going to be drastically wrong. So like a revenue multiple is the right approach, with like a high cost of equity discount rate. So that's what we did. But really, I think what's much more important from an investing standpoint is just going to be looking at the leadership team, and how do they grow to be 10x their size on a launch cadence basis or whatever, going forward. What's the ultimate goal that they're trying to solve? That's what I'd say about that.
Yeah, and what I think you said, Matt, that sticks out is like you got to look at some of these companies as almost like a venture fund. The total addressable market for Rocket Lab is evolving quickly. And so traditional analysts, they're not used to looking at a brand new kind of total addressable market emerging. The space industry, we think is something special that's really emerging later, the second half of this decade, especially. But Rocket Lab is going to play a big part of that. And so from a venture, it's almost like a venture, I guess a perspective as a venture fund, like you're investing in a company with a strong founder that has a stable footing already in a space that's growing really fast, and is going to be a big part of the future of that total addressable market. I don't know. It's kind of like wishy-washy words I'm throwing out there, but but you have to really just believe in, I guess, this space that they're growing into, and think that the space industry is going to be much bigger than it is now in 5 or 10 years.
Yeah, well, even Deutsche Bank, who I kind of view as like not particularly forward thinking in a lot of regards. They're calling it one of their top picks for 2022, and they expect the stock to go up 120%. So even though it's hard to model this stuff financially, I think like at a bare minimum as a financial analyst, if you say, okay, I don't want to put a technical hat on, I don't know anything about space, you can say, okay, Rocket Lab is worth, or SpaceX is worth $100 billion reportedly. What is the second place worth? And so it's probably worth more than 2% of that
SpaceX's
value.
Like, yeah.
So that's maybe like one kind of rudimentary technique you could have, is to say, okay, like what are other companies in the space being valued at? And if they really are the clear second place, which I think it's indisputable. Like maybe if you're really backward looking, you could say like ULA is above Rocket Lab, but that's like, I don't think that's accurate at all. So
yeah. All right, from Harshal Owalakar, with Tesla expanding the insurance business to cover 80% of the U.S. population, how do you scope the competitive landscape for Lemonade or Metrolink auto insurance? Metromile, I'm sure.
Metromile, I think that means,
yeah. So it's funny. We have a really cool 2-minute video coming out shortly. We'll post soon that we put together, kind of describing in a nutshell a lot of the case for Lemonade. But I think Tesla expanding insurance business to cover 80% of the. 80% of the U.S. population, for them to have 80% of auto sales in the U.S., that's a pretty big assumption.
I think he must be meaning 80% of states or something like that.
Oh, I see. Okay. Yeah. How do you scope the competitive landscape? I think Tesla proving out auto insurance and disrupting it in their own right for their own cars is actually good for Lemonade. It just shows like, hey, Tesla can do this. Lemonade's going to be doing it too for everything that's not a Tesla. So I think it's actually really good for Lemonade. The more Tesla gets into this business, it kind of like, Tesla can break down some of the initial, like they already had fights with California's, Elon's already been tweeting back and forth with someone in California's insurance regulator industry, saying they want telematics, and the insurance guy was like, no, we're fighting for customer privacy, or I don't know, something like that. So Tesla's breaking down some of these walls ahead of time for Lemonade to easily kind of, piggyback off of too. So I think it's complementary. It's sort of like EVs. Like the more EVs you have out there that's not a Tesla, it's actually good for Tesla EV anyway, because then it brings more awareness to this new EV industry. It brings more awareness to the new type of auto insurance, calculations and such, I think. What do you think?
Yeah, like to me, like Tesla's not going to have anything close to like even 50% of like the total automotive insurance market, in the United States. I mean,
Yeah.
even once they're kind of at scale at 20 million units a year, and there's a large fleet out there, there's still going to be plenty of room for other insurance providers. So the question in my mind is not like who wins kind of one upstart in the insurance space, Tesla, versus one upstart in the insurance space, Lemonade, Metromile. It's okay, how much are the incumbents going to lose, and how do they transition to like the future is inevitably going to be like risk-based insurance premiums, based on the individual driving characteristics of the underlying insured users. Like that's just very clearly like the right way, the most appropriate way to risk assess, to underwrite insurance, automotive insurance. And so in my mind, the two who are leading on that are really Metromile and Tesla, which is just starting this. There's some others that have like a little black box that you can put in for like 3 months and get a rate, and then they take it out and they ship that box off to somebody else. But to really have great telematics that are always adjusting, and your rates are getting adjusted based on your driving behavior continuously, you need not only good telematics, but also like, frankly, probably a bit of like AI and like how Tesla developed their safety score. Like there are so many variables to look at, which ones are most correlated with accidents. And you need a huge data set, and you need to understand how to mine that data set appropriately. And so you need like some sort of AI component in that as well. And so it's not clear to me that the insurance incumbents are moving in that direction whatsoever. So I think there's room for Tesla and Lemonade to eat the lunch of a lot of the incumbents, which is going to be very bad news for them.
Yeah. Yep. Second question from Harshal Awalakar is, when Tesla licenses full self-driving to other OEMs in the future, it would be logical next step for Tesla to expand its insurance to other OEMs with the advantage of telemetrics from full self-driving. Any thoughts? Matt, what do you think?
I mean, it's kind of there's a presumption in that question that Tesla would license FSD to other OEMs. And if they do that, then I kind of agree. But they would essentially need to have the same hardware set that Tesla is using. And just based on my experience with like the big companies, like they don't want to admit that they're not the technological leaders. They don't want to hand over, a core piece of like their technology or of their platform to a competitor within the space. So even though I do think it would be in the other OEM's best interest to license FSD and let Tesla do the insurance for it as well, I don't think the agents who run those companies will come to that conclusion and actually license it. So I hope I'm wrong. I hope they're a little bit more forward thinking than I'm giving them credit for. But my sense is they'd rather like lose billions investing in Cruise or something like that than license from Tesla and be paying out thousands of dollars for each vehicle they sell.
Yeah, and Elon said theoretically they do it. It would be all EVs. I think he would license it, but also the other the auto manufacturers, they'd have to build their cars like pretty much identical to Tesla in some respects, like cameras in the exact same placement, probably. Right. They'd have to. Tesla doesn't want to like use its engineering resources to like necessarily like work with adjusting their platform to fit another auto manufacturer's building style of building out the sensor suite or cameras and such. So it's going to be tricky. Yeah, I mean, I just don't know if there's a pragmatic or practical way that's going to happen. But theoretically Tesla's open to it. But I just, like you said, Matt, I can't see the other players kind of just giving in 100% to Tesla and say, "Oh yeah, you give us the specs of exactly how to design our car, and we'll just do it the way you say," without even trying to push back or something,
Yeah. I mean, like no other car company is even thinking that vision only is the right approach to autonomy, let alone like agreeing to Tesla's kind of hardware suite and full self-driving computer and everything. So there are, I think several obstacles that need to be overcome before, you know, you can kind of consider this as a potential outcome.
Yeah. From David Kastman, does full self-driving and Optimus increasing possible total addressable market mean that good soil might now weight more heavily towards Tesla? Yeah, I mean, it certainly does. Matt and I talk about this stuff frequently. You know, we view Tesla as our highest conviction name. We already weighted very heavily towards Tesla. So, you know, the Optimus thing is still, you know, I'm a huge fan of the bot, and I can't wait to see more about this. You know, the prototype, I can't wait to see. You know, I've been excited about this Tesla bot ever since AI Day, and so, you know, but that could be years away from production and delivery. You know, so but it's certainly science fiction, you know, coming to reality. You know, it's exciting. Full self-driving near term, you know, that's more of a near-term catalyst. You know, later this year or next year, we think it'll play a big part in the financials of Tesla. So, yeah, I mean, I think the total addressable market for Tesla is expanding. It's a 1 trillion market cap company approximately. So, you know, the chances of it going up, you know, 3, 5, or 10x, you know, you need those things to really come to fruition, right? And it could take some time for the bot, for example. But other stocks that we look at, you know, have smaller market caps, like, you know, Lemonade's around 2 billion market cap or whatever. And we think that could go to, you know, 3, 5, 10x much quicker than Tesla, for example. But, you know, from a safety perspective, like what we think is most of a sure thing, Tesla obviously seems like more of a sure thing to us. But, you know, we try to take risks where we think there's a good skew and the risk reward, and weigh it appropriately in our portfolio. Matt, anything else you kind of want to add?
Yeah, I mean, we were basically just having this conversation yesterday. You know, I think right now the only thing I would add is like Optimus is probably not going to get much market credit in the next 12 months, say.
Yeah.
And in the event of like a market downturn, so let's say we're wrong on macro, and macro like drastically deteriorates this year. I think even in that scenario, Tesla is probably the safest name in the portfolio, just because they've got, you know, current year earnings, which can kind of gird valuation to a certain extent. You know, whereas, you know, Roblox, Lemonade, Rocket Lab are, you know, they're more story stocks. So I think we've been looking at things in that light a little bit more and saying, okay, you know, there's a little bit of a safety element, but there still is that kind of, you know, long-term 10x potential. But if we're right, then some of the other names, the kind of story stocks which have been hit harder than Tesla, maybe they have more opportunity to rebound as well. So, you know, it's a little bit of that risk reward trade-off as well. But I think across the kind of distribution of possible outcomes that we see in the market, I think Tesla does seem to have emerged as an even higher conviction name, if that's even possible.
Next question from J Kimo11 on YouTube. Do you think the Fed will prop up the markets through summer because of midterm elections in the US, and then after November, the interest rate hikes will begin? That's certainly possible. I mean, if the market continues to kind of, you know, come down, and we're like on the cusp of a recession and the market, a bear market, you know, if you know, if that happens this month going into their next meeting, you know, I could see strong signaling to kind of push back interest rate hikes in fear of, you know, sending the stock market into a deeper bear market or a recession. You know, there's certain, like, as much as, you know, you want to think that the Chairman Powell and his team are like neutral completely on politics and election cycles. I think that's naive to believe that's true. I think there is some, whether it's said or unsaid, I believe there is some influence on some things with what they do. You know, they don't want to. You know, they don't want to crash the market anyway, but especially in an election year where, like, you know, tons of Congress folks are being voted in or out, you know, Democrats or Republicans. You know, I don't know if they want to feel responsible for swaying election results by crashing the markets, but they also don't want to crash the markets into a bear market anyway. So it's possible, that they might hold off. I don't know if it's probable, but I think it's certainly a scenario to consider.
I might disagree with you on that a little bit, actually, Emmett.
Okay.
Like Powell came into office, during the Trump administration, and was kind of stuck around through Biden administration, and I think he's been mostly apolitical. And if you look at the Fed's actual stated mandates, it's to maximize employment and keep inflation kind of within reasonable levels. And so I think right now, Jerome Powell's statements or sentiment seems to be that inflation risk is very real. And so you kind of need to increase interest rates to kind of get that under wraps a little bit. They don't have a mandate to kind of like keep the stock market at high levels or anything like that. I think I would agree they do take that into consideration. Like, you don't want to just like raise rates and like see the Dow or the S&P like get cut in half. So I'm sure, even though it's not a technical mandate of theirs, I'm sure they kind of take that into consideration. But to me, I kind of have trouble seeing that, there's kind of like some election-based thing where they want to see a certain kind of political outcome, and so they're going to prop up the economy, until that happens, and then kind of drastically change course. I don't think there's much kind of history for that sort of behavior, and the fact that Powell's been in there over 2 administrations kind of makes me think he'd avoid that sort of thing.
Yeah. I mean, you can just, I think, I just look back to when he had to meet with Biden a few months back when they were considering another chairman. It just seemed, kind of conspicuous that he met with Biden and was able to keep his job, but at the same time turned very hawkish, very suddenly, abruptly, and that just to me seemed like more than a coincidence. But I'm not saying that's the only reason he turned very hawkish. Inflation numbers have been, creeping into people's minds, and it's certainly there, but he'd been saying it's transient up to that point. And I do think there's some element of political influence, whether they want to admit it or not. Just it's part of the game he's in, trying to hold on to his seat as Fed chairman and such. So, yeah, I mean, I hope what you're saying is true, that he sticks by his mandate, only or primarily. But I do fear that there is some kind of political influence going on. So who knows? But we can disagree. It's okay.
It's healthy.
It's healthy, yeah. So from Jonas Allen, what's your take on Peru Saxona's view that we've still got about 15% downward pressure to go to the indices? He's been spot on so far throughout his whole downturn. Curious to hear your thoughts. I did hear his interview on Dave Lee's channel a while back, but I was really thrown off with all the technical analysis that he really seems to favor. When people talk a lot about that, that's just so far from my spectrum of investing, practice, using that type of technical analysis. I mean, not saying I think it's too much like astrology. Everything's always different. The future can sometimes rhyme with the past, but when it comes to stock markets in particular, the movement of stock markets, it's just very complicated. And yeah, I don't know. I'm not a fan of of technical analysis. Not that the guy Peru, he seems very smart. Seems like he's accomplished a lot. But there are going to be some technical analysis folks that seem to get it right a lot because they've been lucky. Just like the old boiler room stock picking thing. They send a letter out to 100 people to buy this stock and 100 people to buy this stock, and they're right. And then they dwindle. There's going to be some people that kind of through just being lucky over time are going to seem like they know the markets through their technical analysis, but the vast majority of folks, I think, get it wrong a lot too. So I don't know. Any thoughts, Ben?
Yeah, I do tend to agree with you on technical analysis. I mean, I just think back to January 4th when we had that huge rally on the Tesla production and delivery numbers, and I was looking at a lot of the people who do technical analysis on Tesla out there, and they're all saying we've got a great support level at 1,050, and the next resistance is 1,225 or whatever, and like dumped right through all these so-called support levels and everything. And like, not to say there's no validity in technical analysis, because I think there's, there's some, but to me, to use that as like a reliable kind of to beat markets, I don't think that happens to any great degree. So, my take is I'd rather be invested in, a company that will, rather than try to like perfectly time the 15% bottom, I'd rather, stick with the company through that 15% drawdown, if that even is right, and stick around through like the 10x upside that we see in the next 5 to 10 years. And layer in some use of derivatives when we think there's kind of near-term catalysts to accelerate those returns. To me, that's a much more attractive play than like, I'm going to go all cash until we get like to minus 15%, then I'll like redeploy it and magically get the up, like all the upturn. That people just don't get that right very often, or very consistently. I should
consistently. Yeah, and for every technical analysis kind of rules-based technical analysis person that seems right, there's 10 that we've forgotten about that were putting themselves out there. Yeah, so just that's what it seems like to me. So anyway, let's go to the next question here from Farzad. Hey Farzad, how are you, man? I saw your chats recently with Steve Mark Ryan. That was really, really good. Farzad has his own YouTube channel, by the way, if anyone doesn't know. He's doing really well with that. All right, so do you think Tesla being upgraded to investment grade is a legitimate catalyst? Chances that it's already priced in based on obvious cash flow generation, both short and long term. I mean, I think when Tesla gets upgraded next to be like investment grade, I think that opens the door for a number of traditional Dino Wall Street funds, 40 Act fund, Investment Act 1940 funds, like mutual funds and such, that maybe a lot of them have rules baked into their prospectus that they're only allowed to invest in investment grade level companies or something like that. And so there's probably portfolio managers at some decision makers at those firms that would love to buy Tesla, but they just can't because of rules. And now they'll have that will be gone. And I think it is a legitimate catalyst potential, and I don't think it's baked in. So whether it kicks the stock up a couple notches really quickly, like the next day, I don't know if that's going to happen. But I would say for the next few months after the investment grade upgrade, then I think that's, to me, it could be a bullish indicator on the stock for the next few months. What do you think, Matt?
Yeah, I mean, I could rant on this for a while, and I think I actually have done that recently, just about how ridiculous the current credit ratings are for Tesla. But yeah, I do think it could be a catalyst. Like, I don't think it would be anything approaching the territory of S&P 500 inclusion, but I do think it could kind of provide some incremental like momentum as a couple, larger institutions, put like a 2% allocation in there or something like that. I think that could certainly help. But yeah, I think to me, it's part of like a broader conversation of like, how mainstream will Tesla get? Because even within a lot of traditional institutions, it's still viewed with a high degree of skepticism. Like, well, they're already $1 trillion valuation. Clearly they can't go up from here, or there's like maybe they go up to like 1.4, but like people just have this like mental model of what's possible in their head, and it's very limiting, and it's a limiting way of looking at it. But yeah. Farzad, though, loved your interview with Steve Mark Ryan as well. So everyone check out his stuff if you haven't already.
Yeah. And the last question, let's do one more question. Let's see here. From Deadly Soul 007. Oh, I like that name.
Ooh,
all right.
Ooh, spooky.
Is full self-driving adoption enough for nutty financials, or does robotaxi need to happen? If so, what is the critical mass of Teslas per capita to allow for robotaxi to operate? I don't know, Matt, you have any thoughts on this one?
Yeah. Dave Lee actually did like a really good kind of visual of like the step changes of like just FSD as like an option kind of gets to like really good financials, and then robotaxis gets to nutty financials, and then like like to the Tesla bot Optimus Subprime gets to like just like mind-blowing like tens of trillions of like potential financials. So I do think there's that general framework seems about right. Like when I'm doing some modeling, it's like, okay, you can have like, call it 2 to 4x, maybe like 1.5 to 4x increase in like financials just on the back of FSD, absent like robo taxis. So kind of like I was saying earlier, if you double the profitability per vehicle, if you get, full adoption of full self-driving. So like that's a huge lever. But then if you both double the price of full self-driving and you get to a full adoption, then that's like, a 4x. So that's, you can't charge like $100,000 for full self-driving without solving like autonomy and making robo taxis a reality, because nobody's going to pay that much for just a convenience feature. But you can probably charge 25,000 and maybe it's like a 50% take rate or something like that. So I think to get to really nutty financials where you're talking about like not like a 50 to 100% increase in like earnings per share, say, but like 10x potential in profitability and like, tens of billions of cash flow per quarter. That's when you really do need autonomous robo taxis. So it's kind of nice because there's like a step change there where it's like maybe the stock price will start to reflect an increase in take rate, once it becomes clear that, the software is getting that good. And then at that point, once more people see it, then they'll start giving a little bit of credit for robotaxi capability. So I think the stock will, there's a good chance the stock kind of recognizes this stuff ahead of their actual implementation. But in terms of like backward looking financial statements, it's going to be, I really do think it's going to be nutty, because I was coming to the same conclusion, and you can hear James Dalma talk about it. Like if you just look at the numbers of like the profitability and like the increase in utility that it's going to offer and like how much cost saving it's going to enable, it will like by its very nature encourage a high uptake rate and a high degree of utilization on like the Tesla network, just because it's going to be so much cheaper to operate than anything else out there. And when you run those financials in great detail, the results really are nutty. Like I've got this model, and it's without like the most nutty assumptions possible. I'm still coming up with like $200 to $400 billion in like EBITDA by the end of the decade. So it's like if they're doing that, then what do you apply like a 20 or 40 EBITDA multiple to that? It's like, that's a nutty share price implication. But it's not even the most bullish case. So, but in terms of like Tesla's per capita, I don't know. I mean, you clearly need, if you're going to be utilizing the vehicles like 4x more than the current vehicles are, that would imply roughly that, there's like 25% of the vehicles out there today would be needed in the long term. But that whole transition will take some time.
Yeah.
Emmet, do you have any thoughts?
No, thanks for taking on most of the talking today, Matt. Just sorry, guys, I've been under the weather with the Omicron, just getting over it. And we'll be back next week and on our live stream again. And hopefully macro market hasn't capitulated again by that time. So so we'll see. So thanks everyone for listening. And we'll this will be recorded on our YouTube live channel and so forth.